You are 44 and you have $31 million in municipal and corporate bonds, generating $1.4 million annually in interest income, taxed at rates your accountant describes, without irony, as almost embarrassingly favorable. You opened a crypto exchange account once, in 2021, deposited $2,000, watched it become $6,800 within 4 months, told 3 friends about it at a dinner, watched it become $1,100 over the following year, and closed the account permanently in early 2023. You don't trade anymore. You haven't checked a coin price since. You are sitting in your study reviewing a bond ladder your wealth manager restructured last quarter. 14 separate maturities staggered across the next 22 years, each one selected not for excitement, but for the specific, almost boring certainty of knowing exactly what it will pay you and exactly when. By the end of this video, you'll definitely see that the wealthiest people in the world are overwhelmingly boring with their money, in ways the financial entertainment industry has every incentive to hide from you. And the gap between trading crypto and holding bonds isn't a gap in sophistication, it's a gap in what each instrument is actually designed to do. You'll find out exactly why the bond market is larger than every stock market and every crypto market combined, and almost nobody under 35 has ever been taught why that matters. This is your life, while you trade crypto and the elite hold bonds. Chapter 1. The Allure. You are 24 and you put $3,000 into a cryptocurrency in March, after a coworker mentioned it had gone up 40% that month alone. The coin rises another 60% over 6 weeks. You check the app 11 times a day, the dopamine hit of the green number arriving faster and more reliably than almost anything else in your daily life. You tell your roommate about it. He puts in $1,500. You both watch the chart together on a Friday night instead of going out, the green candles feeling like evidence of something you'd always suspected about yourself, that you were early to something, that you understood a market other people hadn't figured out yet. The coin drops 34% in a single week in May, on no specific news, simply because a different, larger coin had a bad day and dragged the entire category down with it. You don't sell, you buy more at a lower price, using the exact logic that feels like discipline and is actually something closer to fear dressed up as conviction. You don't know yet that the entire global cryptocurrency market, at its peak that year, was worth roughly $3 trillion. You don't know that the global bond market, the same year, was worth over $130 trillion, more than 40 times larger, moving trillions of dollars daily in transactions so unremarkable they rarely make headlines, funding governments, corporations, and infrastructure projects that quietly compound for the people holding them, while everyone your age is watching a different, much smaller market for entertainment. The first rule: at 24, the instrument that feels the most exciting is almost always the smallest, least understood, and least connected to how actual large capital moves through the world. Chapter 2. The First Bond. You are 27, and your grandmother, before she passes, leaves you $40,000 specifically earmarked in her will, not for trading, for holding. Your financial advisor, your grandmother's advisor for 30 years, inherited along with the money, suggests a laddered municipal bond portfolio. You ask what that means. He explains. Bonds issued by state and local governments, the interest largely exempt from federal tax, maturities staggered so that a portion of the money becomes available every few years without you having to sell anything early or guess about market timing. You find this almost insultingly boring compared to the crypto chart you'd been watching for 3 years. The expected return is roughly 3.8% annually, tax-free. Your crypto position, in its best 6-week stretch, did 60%. You ask your advisor, somewhat pointedly, why anyone would choose 3.8% over 60%. He says something that takes you nearly a decade to fully understand. The 60% was a 6-week stretch inside a much longer period where the same asset lost 70% of its value, and several similar assets went to zero entirely. The 3.8% is not the best 6 weeks. It is every single year for as long as the bond exists, paid on a schedule, backed by the taxing authority of an actual government. You are comparing the best possible outcome of one instrument to the average outcome of another, and that comparison, structurally, will always make the volatile asset look better in the short term and worse over any meaningful time horizon. You invest the $40,000 anyway, mostly out of respect for your grandmother's wishes, and check the account perhaps 4 times in the first year. a radically different relationship with money than the 11 times daily crypto checking habit from 3 years earlier. The second rule, at 27, you encounter, for the first time, an instrument designed specifically to be boring. And the boredom itself is the entire value proposition, not a flaw in it. Chapter 3. The Comparison. You are 30, and you run the actual numbers for the first time, comparing your crypto position's total return since 2021 against the bond ladder's total return over the same 3-year period. The crypto position, after the initial rise, the 34% crash, the additional purchases at lower prices, a partial recovery, and another significant drawdown during a broader market downturn, is worth $4,100, a 37% gain on your original $3,000, achieved with extraordinary volatility, dozens of hours of attention, and a level of stress that, in retrospect, seems disproportionate to the actual dollar outcome. The bond ladder started with $40,000, having paid consistent tax-free interest every year with zero drama, zero attention required, and zero stress, is worth $44,700. A smaller percentage gain, but achieved through a mechanism that required you to do, functionally, nothing. This is also exactly the period where you start to understand something larger about how inflation interacts with each of these instruments differently, because the relationship between inflation, asset type, and who actually benefits from monetary expansion is a separate but deeply connected mechanism. I broke down the full 6-level framework of how inflation actually treats people differently depending on what they're holding, from cash sitting idle to fixed-rate debt on appreciating assets, in the video appearing right now. But for now, let's stay with what happens as your bond knowledge starts to compound alongside your capital. You begin reading about treasury bonds, corporate bonds, and the actual mechanics of yield curves. Not because anyone assigned it to you, but because the boring asset has, almost accidentally, outperformed the exciting one over a real-time horizon. And that fact alone makes the subject considerably more interesting than it appeared at 27. The third rule, at 30, you discover that the comparison almost nobody runs honestly. Total return over multiple years, including all the drawdowns, not just the highlight reel, almost always favors the instrument that never tried to entertain you. Chapter 4. The Allocation Shift. You are 33, and your net worth crosses $310,000. The bulk of it now split between equity index funds, the bond ladder grown to $58,000 through additional contributions, and a crypto position you've reduced to a small, deliberately contained allocation, roughly 2% of your total portfolio. Money you've explicitly decided you can lose entirely without it affecting anything that matters. This reframing changes your entire relationship to the volatile asset. You're no longer checking it 11 times a day because 11 times a day checking only makes sense when the position represents something meaningful to your actual financial security. At 2% of your portfolio, the daily movement is, mathematically, almost irrelevant to your net worth. And the psychological relief of that irrelevance is, itself, worth more than almost any return the position has ever generated. You also start, for the first time, holding Treasury Inflation-Protected Securities, TIPS, a bond structure specifically designed to adjust its principal value with inflation, ensuring the real purchasing power of your investment doesn't erode the way ordinary cash sitting in a checking account does. This is the same mechanism, approached from a completely different angle, that the inflation video covers in full. Except here, instead of using real estate or fixed-rate debt to stand on the right side of inflation, you're using a government instrument specifically engineered for that exact purpose. The fourth rule, at $310,000, the goal shifts from which asset performs best to which combination of assets lets me sleep well while still growing. And bonds, structured correctly, are doing more of that second job than almost anything else in your portfolio. Chapter 5. The Family Office Conversation. You are 38 and your net worth crosses $4.2 million, the result of a business sale combined with 11 years of consistent investing across equities, real estate, and the now substantial bond ladder. Your new wealth manager, onboarding you into a more sophisticated planning process, shows you data that genuinely surprises you. The largest institutional pools of capital in the world, pension funds, insurance companies, sovereign wealth funds, university endowments, hold on average between 25% and 40% of their total assets in bonds, not because bond returns are spectacular, but because bonds provide the predictable, scheduled cash flow these institutions need to meet known future obligations, pension payments, insurance claims, operating budgets, with a level of certainty that equities, and certainly crypto, can never reliably provide. You learned that the U.S. Treasury bond market alone moves over $600 billion in trading volume on an average single day, more than the entire cryptocurrency market trades in most weeks. You learned that corporate America itself, the same companies whose stock everyone watches obsessively, raises far more capital through bond issuance than through stock issuance, because bonds are cheaper, more predictable, and don't dilute ownership. The fifth rule, at $4.2 million, you finally see the actual scale comparison the entertainment industry has no incentive to show you. The boring market is not a smaller, less sophisticated alternative to the exciting one. It is the larger, more foundational market. And the exciting one is, relative to it, a sideshow that happens to generate excellent content. Chapter 6. The strategy becomes the identity. You are 41 and your net worth crosses $19 million. Your bond allocation, now a deliberately structured ladder spanning treasury bonds, municipal bonds, and a smaller allocation of investment-grade corporate bonds, generating predictable income that covers almost exactly your annual living expenses without requiring you to sell a single equity position, regardless of what the stock market does in any given year. This structure means something specific that took you nearly 2 decades to fully appreciate. You are now insulated almost entirely from having to make a financial decision under emotional pressure. When markets crash, and they did meaningfully twice during this period, you don't sell equities at the bottom to cover expenses because the bond income is already covering expenses on schedule regardless of what's happening anywhere else in your portfolio. Your old roommate, the one who put $1,500 into the same coin you did at 24, still trades actively. You have lunch with him occasionally. He mentions this year that he's up significantly on a different coin, the specific number arriving with the same energy the original conversation had 17 years earlier. You don't ask what his total return has been across the full period, including everything he's lost along the way. You suspect, based on patterns you've watched repeat across dozens of people in similar positions, that the honest number would not match the energy of the story. The sixth rule, at $19 million, you understand that the strategy itself has become indistinguishable from your actual financial identity, and the identity is, almost entirely, the opposite of exciting. Chapter 7. The Quiet Machine. You are 44, sitting in your study, the 14 maturity bond ladder spread across the desk in your wealth manager's summary report. $1.4 million in annual interest income, arriving on a schedule you could recite from memory, taxed at rates that exist specifically because municipal governments need capital, and the federal government has decided, structurally, to subsidize that need by exempting the interest from federal tax. A policy decision made decades before you were born, benefiting you specifically because you eventually learned to position capital to receive it. You think about the $2,000 crypto account from 2021, the dinner conversation where you told 3 friends, the closed account 2 years later. You don't regret the experience exactly. It taught you something about volatility and your own psychology that no amount of reading would have taught you as effectively. But you recognize, with the specific clarity that only comes from running the actual numbers over a long enough period, that the lesson cost you considerably more in stress and attention than it ever paid you in dollars. Somewhere right now, someone is 24, watching a green candle on a chart, telling a friend about it at dinner, feeling like they've found something other people haven't figured out yet. They haven't found something new. They've found the oldest story in finance. The instrument that feels the most alive is almost never the one doing the actual heavy lifting for the people who already have real capital to protect. The bond market isn't exciting. It was never supposed to be. It was supposed to work, quietly, for decades, while everyone else watched a much smaller, much louder market and called it sophistication. Stop watching the chart. Start reading the ladder.